Okay, great. So we're going to get started now. Very, very, very excited for this workshop today. We've got Ramona Cedeno teaching 10 tax deductions you don't want to miss. This is obviously very timely as it's tax time, everyone. And if you haven't thought at all about taxes for your business yet, not to fear, Ramona is going to give you lots of great info today. So Ramona is CPA and she is the founder and CEO of FiBrick Financial Services. That's an accounting and fractional CFO services firm. Through the many services and workshops her firm provides, Ramona enjoys and takes pride in her innate ability to bring people together to build community and financially empower women to build sustainable businesses. She is also a proud mentor of the Women Entrepreneurs of NYC, We NYC, and that's an initiative where she leads mentor sessions and workshops aimed at helping women start and grow their businesses. Ramona holds a CPA and CFP license, so she is expertly tailored in teaching this workshop, and we're super psyched to have her. So I'll turn it over to you, Ramona.
Thank you so much, Julia, and I'm so happy that iFund Women is giving me this opportunity. As you probably know, these are exciting times for me, of course, yes. A lot of work helping entrepreneurs with their tax issues and questions and just educating. And my team, of course, is here to help, and we love what we do. And these workshops, we find them very useful for many, many reasons, but I hope you get a lot out of it. And if you have questions, you can ask the questions throughout the session. Email me after, reach out to me on LinkedIn or any other social media platforms, and I'll be happy to help you. Let's get started. So 10 tax deductions you don't want to miss. Sometimes it looks like it might come across as if this is something that we should all know, but believe it or not, a lot of business owners don't know what they can deduct, how much, what's allowed. And so I get these questions all the time. So I think this workshop is as timely and right on point. We have an agenda for the next hour. So the first thing is I'll go over 10 deductions that you don't want to miss for your business. I'll talk about 3 credits, tax credits that are common for small businesses, and 7 tips. I'll give you 7 tips to avoid losing sleep over taxes. And finally, I'll do a quick a demo on how to use QuickBooks to keep your finances, your business finances organized, so that year end comes in and you don't have to struggle to try to find your income and expenses and what do I give my accountant and what do I have everything that I need to have. So let's get started with the bio. So Julia already gave you a nice bio about myself, so thank you, and this will be here for you to refer to in the future. Let's talk about the deductions. The first one I wanted to bring up is startup costs. And this question comes up when business owners are just setting up their idea for a business or are doing some business, but they haven't registered the company formally. They ask me, what can I do with these costs that I'm incurring today, but my company is really going to open for operations next year? So the IRS allows you to deduct up to $5,000 for startup costs and $5,000 for organizational costs the year in which you open for business. So this costs include, for example, if you need to hire a broker to find you an office space, or if you need to have meetings with your future board members and you incur expenses related to those meetings. Those would be startup costs. Organizational costs include lawyers that you hire to give you advice on setting up the entity, tax advisors that you pay any fees to before you open your business. So keep track of these expenses if you are just starting out, if you don't have a formal company, a registered company. Keep track of these expenses this year, and next year, or when you start the business, you'll be able to still deduct those. The next item I want to talk about in terms of deductions is these would be like the general expenses that you can deduct as a business owner, but I bring this up because some of these are obvious, marketing and rent and compensation, insurance, but believe it or not, people do ask, what can I deduct? And they come to me and they say, I take people out, business, other colleagues, my employees, can I deduct those? So all expenses that are reasonable and necessary to run your business can be deducted as a business expense. So reasonable means that they're within a certain an amount that is not exaggerated. So if you tell me that you need to take a luxury car every day to go to the office, I would probably ask whether that is a reasonable expense and whether that compares to what other business owners in your place would be using as a form of transportation. Necessary means that you actually need to incur that expense to run your business. So for example, if you if you're a coach, a therapist, and you need an office space to see your patients, that is a necessary expense, because there is no other place where you can see your patients privately. But if you tell me that you need to have a luxury apartment in Manhattan in order to see your patients, then that might not be a necessary expense. So the IRS has guidelines around what is reasonable, what's necessary, and the baseline that you can use is what the industry defines as reasonable and necessary. So there's a lot of research that you can do to find this information. You can also talk to your tax accountants, but in general, all companies, if they have employees, will have compensation expenses. They will have marketing to attain your clients. They most likely will have rent expense, insurance, and other general and administrative expenses like supplies or legal fees. So all those expenses can be deducted. The third deduction that I want to talk about is the qualified business income deduction. This is new in 2018 with the new tax laws, and this is a great deduction for those that qualify. What this deduction is it allows business owners to take 20% of their taxable business income as a deduction. So if your company makes $100,000 in profits, you would be able to take $20,000 off of that right away. Now, to qualify, there are income limits to qualify for this deduction. There, in some cases, it might be considered high. So if you're single, the deduction starts phasing out at when you have income of $157,000. For married filing joint, it would be more than double that. And the other qualifications or requirements is that you have to be an S Corp, a partnership, a sole proprietorship, or an LLC. So C Corps don't qualify for this deduction. And it's a great deduction. It's a great opportunity to reduce your taxes. It's in effect until 2025, and then after that, it might either get removed or renewed. And again, the income limits will apply, but if you discuss this timely with your accountant, you might be able to adjust your income just by either deferring income or accelerating expenses so that you can fit within that income threshold to qualify for the credit. And there are other exceptions in terms of the type of businesses. Most businesses qualify, but businesses in the service space like consultants, accountants, lawyers, they phase out of this deduction sooner. So again, consult with a tax professional earlier in the year so you can plan and take advantage of this deduction. The next deduction that I want to bring up is the home office deduction. And this is, a lot of us know about this deduction, I hope, but I do want to discuss the carryover requirements because this one is a lot of times overlooked. So the first thing is that the home office deduction is available to business owners that work from home if their home is their primary place of business and they conduct business in their homes regularly. So if you have an office, let's say you work from home most of the times, but you need to have space in the city or somewhere else because you sometimes see clients there, or because you have an employee there in that other location, you can still take the home office deduction. It's not that you can only have, it's not that you need to work only from home, it's just that home needs to be your primary office. You can have secondary offices and still get the deduction. There is the requirement to have an area dedicated to conduct business in your home. It doesn't have to be enclosed. It could be an open area, but that area needs to be dedicated to doing business. And you have the option of selecting to report based on a standard amount that the IRS provides based on the number of feet, the footage used for business times the standard rates that they provide, or you can allocate expenses incurred for the home using the percentage that you allocate to business. So for example, if you have a square footage of 100 feet and you use 20% of that space for business, so let's say your apartment, I know it's a lot larger, I hope, than 100 feet, but let's say your apartment is 100 feet and you use 20 feet for business, you can deduct 20% of the common expenses of that home. And that includes rent, if you're renting, insurance, utilities. If you own, then you can deduct a percentage of the property taxes, the interest on the mortgage if you are still with the mortgage, and the other expenses like insurance and utilities. This is the part where a lot of business owners miss out on, and it is the carryover. So in order to take the deduction for the home office use, you must have taxable income. So if your business is at a loss, the home office deduction is not going to be used in that year. However, you can carry it forward to the future years when you're actually making money. And in order to carry forward, you must report it in the year that you have the loss. And this is what I see a lot of business owners missing out on. So let me give you an example again. So if your company loses money this year, you have a net loss position, and you work from home, and you have a potential deduction of $10,000, you must report that in this year's tax return. It's not going to benefit you this year, but next year, when you do have taxable income, when you're profitable, you will be able to use that $10,000 home office deduction from today in that tax return to reduce your liability, plus the new home office deduction for that year that you're profitable. So start gathering that information, even if you think you're not going to make any money this year for 2019. If you haven't filed your returns and you use your home for office and you're at a loss, go back and gather that information, provide it to your tax accountant so that you can take advantage of this in future years.
Ramona, we have a couple of great questions that have come in about this topic.
Great.
First one of them is from Lena, and she was wondering, I think a couple slides ago, she asked this question of, do you have to have income for this year to claim these expenses? So is that rule that you mentioned, like if you are at a loss this year, you need to report it on any of these deductions to be able to carry over, or is that just for the home office deduction?
No, yes, so you should report all expenses, and if you're at a loss, the deductions will either carry forward or can be used to offset other income depending on your type of entity. So I have another slide where I talk about loss carry forwards, but that is a very good question, is that you should report all your income or your expenses always, and then let the process work and have these questions ready when you review your tax return or before you start the tax return process, filing process.
And then a couple more questions about office space. Would a shared office space like a WeWork be considered a necessary expense?
If you have the space to for the benefit of the business, because it allows you to be closer to customers or allows you to be closer to other parties that you partner with, then yes, definitely.
And then another question was about what about childcare?
Childcare for the owners.
Yes, for the owner of the business.
Yeah, so most benefits that we set up for our businesses have to be available to everyone in the company. So you can set up plans like childcare, medical plans, but those have to be set up as plans, defined benefit plans that are available for you as a business owner, but as you hire people, they have to be available to everyone.
Okay, and then one more question, which was about space used for inventory within your home. So it's not necessarily like a home office, but it's inventory for the actual supply of the company that's used. Would that count as a home office deduction?
So it's inventory for the business or for the,
yes.
Okay, yeah, so inventory, like if you hold it at home, that is, you can deduct that portion of the home office use, yes.
Great. Okay, that's it.
And going back, I want to clarify for the child care, it's not necessarily that you will be able to deduct the care, the full cost of child care. You can have a benefit where you say, we will cover you for emergency child care. 1 day a month we'll give you. It's not the full child care cost, right? That's something that needs to be looked into carefully because it's not a full reimbursement of child care.
Okay, great.
Did I go too far? Okay. All right. So the next item is car and public transportation costs. And this is similar to the home office deduction, where if you are using your personal car for business or are using your Metro card, both for business and personal, you are allowed to deduct the portion that relates to the business. Now, this does not include driving from your office to your, driving from your home to your office. This is driving between clients or using the public transportation between clients or between offices. So if your primary office is home and you have to go to your secondary office to conduct a business meeting, that you can deduct. But if your primary office is in the city at a co-working space, going from your home to that co-working space is not deductible. The IRS focuses a lot on the deduction of car expenses because it's often abused. So it's very important that you keep track of, if you're gonna do mileage deduction or actual expenses, that you keep track of the trips that you made for business reasons with dates, mileage amounts, or the cost that you incur. I have a bullet here on the standard mileage versus the actual expenses. You can choose to take a deduction for car expenses using two methods. The first one is standard mileage. So this is where you say, I drive my car 10 miles, and you have to track the mileage on either of this. I use my car 10 miles per month to go to my client in New Jersey. If you choose to use the standard mileage, you can take that those 10 miles and multiply by the IRS standard mileage rate, which now I believe is 58 cents per mile, and it changes every year. That mileage rate includes everything: the gas, the depreciation of the car. So that's what you get, just the mileage times the rate. You can, in addition to that, deduct extraordinary expenses like repairs or a tire that you need to replace, the portion that's related to business. But with the other method, with the actual expenses, you don't do mileage time rates. you actually just estimate the total expenses, or actually not estimate, you add up all the expenses incurred for the car during the year, gas, tolls, parking, and then you take the percentage of that cost that relates to business. How do you get that percentage? Total mileage for the year, amount of mileage used for business, and then those two, you divide one by the other, you get the percentage, and then you calculate, you multiply that by the actual expenses. I try to give an example each time to simplify it. So let's say you drive your car 10,000 miles a year in total, and 1,000 of that is business. 1,000 over 10,000 will give you the percentage related to business. You then multiply that by the total expenses that you incur for that car in the year, and that's your deduction. Again, it's going to be time consuming, but you need to track the trips, the business trips, because if you get audited for this particular item, you will have to show the records of that.
And there was one question, Ramona, that came through. Are you aware of any apps for tracking mileage for business that you've recommended to your clients?
Yeah, so QuickBooks actually has a mileage app. And if you're already using something like QuickBooks, you can look at their mileage tracking feature. Expensify, which is an expense reporting tool, will have also mileage tracking. I don't know, I'm sure there are some that just do mileage tracking, but the ones that I have come across are the ones that are part of another application.
Thank you. Oh, sorry. I misinterpreted her question. She was saying apps that you can use in your car that will do it for you.
Oh, so that's a good question. That's the one. I haven't come across one that does it yet. I know that the ones that I mentioned before, when you get in the car, you can, before you start, it will ask you, is this a business trip or not? And you can just say yes or no. So no app is going to know unless you do some, maybe there is a way to say, whenever I go from here to there, it's business, but most of them are going to ask you at the beginning of the trip, is this a business trip or not, or personal? And that's the most I have seen them do. But I'm a techie too. I love to see automation of things. So I'm thinking like there should be someone out there with something that says, when I go from home to this direction, mark it as personal. I haven't come across any that does it yet, but it might be there. Good. Okay, so one deduction that is a lot of times overlooked, and is, well, in many cases it's because of cash flow. We just don't want to invest, put our business profits into this, is retirement plan contributions. And this is a great way to reduce the tax liability, defer the taxes until retirement, but also save for yourself and for your employees if you want to extend a plan to them. And the way the retirement plan contributions work is that the company, and any company can do this, any type, even a sole proprietorship can do this. The company sets up a retirement plan on behalf of the employees, which would be the owner, if it's just the owner, or the owners plus the employees. And you have the choice of setting up a SEP, which is one where the company is the only one making contributions, or other popular ones are simple and the 401k. The difference between the simple and the 401k is just the max amount, the maximum amount of contributions you can make. With the simple, it's a lot less than with the 401k. The simple, I believe now is at 13,000, but with the 401k, we can do 19,000 plus the company matching. So both the simple and the 401k have a company match. If you are a solopreneur, a SEP is a great way to invest, to contribute for retirement and to reduce taxes. Because what the SEP does is it allows the companies to contribute on your behalf or on behalf of the employees up to 25% of the employees or the owner's salaries. So if you make $100,000 that you pay yourself as a salary, the company can contribute $25,000 on your behalf to a retirement plan. With the stimper on the 401k, the company is matching. So you as an employee would decide how much you want to contribute up to the max amount allowed. So let's say the 401k, you can contribute up to $19,000 per year, and then the company can do a match, and that number increases. The thing to keep in mind is that in most of all these plans, at some point, we require that you include your employees. So the one to choose, the plan to choose, would be the one that you can afford as an employer, but that still gives the company, the employees, the benefits. So the set might be a little costly as you grow, because if you set it up to contribute 10% for everyone, it will be 10% for you and all your employees. Whereas if you have a 401k, you can set it up where the company contributes only 3% or up to 4%, and the rest is contributed by the employees. I'll stop and let some questions come in if anyone has questions here, because this is there is a lot there.
There is a question. It is from Georgia. As someone who just moved to a new city, what advice do you have for finding an accountant or tax professional who will be familiar with these startup/business deductions? And also, what is a reasonable amount to pay for those services?
I think the best way to find professionals for any field is to get to know them through referrals, or meet them a couple of times, talk to them, and then get a vibe of whether they're a good fit for you. You ask certain questions that you had before that no one was able to answer, right? So if you notice that I'm talking about something here that no one ever mentioned before, when you speak to a prospective service provider, you ask a question about that topic, and you can see what they come back with. And if you like the answer, you can move on to another question, or just talk to if you meet them at a networking event, you can talk to people that know them and just get a vibe of who they are. And there are a few things that might be important to you, like responsiveness, whether they are focused when they talk to you, just different things, personality. So that is important. In terms of pricing, it varies very widely, especially in New York. If you're just doing tax preparation, is one fee, and it still varies based on the provider. But if you add on support during the year, someone to give you advice, then the price is going to increase. It's really hard to give you a standard, but it's happy to talk to you after offline, and you can compare. I can give you our pricing, and then you can compare use that to compare with other providers.
So somebody is asking, and also I would note for iFund Women people on the phone, this is a great topic to bring up in our Slack community, and just see if any other entrepreneurs in our Slack universe are connected with CPAs that they love in their cities, if their city is the same as yours. So that's certainly something you can ask about in perhaps the general channel. Samantha is asking, for the retirement plan, is this only for self-business owners? She has a corporate job that she contributes to. Can she deduct that?
Oh, so that's great that she has a plan through her employer. So if the employer provides a 401k plan, that's already deducted from your income. So what they do is they are contributing it pre-tax, so you don't get an additional deduction. And that's the case in for most 401k plans. There is a type that is a Roth, where the contribution is made after taxes, and that the goal there is not to deduct it, because with the Roth, and I'm mentioning this in case that's the type they have, there is a Roth 401k out there. With the Roth, you don't get a deduction, it's not pre-tax. But the benefit of that is that when you retire, you don't pay taxes on the gain. So you're paying taxes now, but you don't pay taxes again ever if you wait for retirement. So it's a little expensive now because you don't get the deduction, but the benefit can be huge. But no, if you're in a plan with the company, with your employer, most likely that's already pre-tax. And you can ask them, and they'll probably be able to answer it like on the spot.
Great. She said, yes, it is a Roth. So perfect. Thank you.
Okay, good. Great. So this is the item that we were talking about before. Net operating losses, carryovers. So if your company ends up with a net loss, where this is where your expenses are higher than your revenue, you can carry over to future periods to offset future profits. There are some limits. You will be able to use up all your losses, but since 2018, we are only able to use up to 80% of the taxable income in any given year, and the rest gets carried over. So let me give you an example. If you have a loss of $100,000 in 2020, you have $100,000 to carry forward. Next year, if your net profit is $100,000, you cannot use the full $100,000 loss. You can only use $80,000, up to 80%. The other 20 then gets carried over to 2022. If you are a pass-through business, an S Corp or a single member LLC, a partnership, you can actually use those losses to deduct other income, W-2 income. There are some limitations too. With a single member LLC, you get to deduct dollar for dollar. So if you have a sole proprietorship or a single member LLC and you lose $20,000 this year from the business and you have W-2 income, you can use those losses to offset that W-2 income in the current year. If you're a partnership, there are other calculations that are taken into consideration to determine how much you can use as an operating loss deduction in your other types of income. And that calculation is based on how much equity you have in the partnership, how much money you have invested, how much income you have from other years. But again, anything not used in this current year, you can carry over to future years, so you don't lose it. The important thing is to report all the losses when they happen, because if you don't report your expenses for 2020, let's say, and you realize in 2 years from now that you could have deducted this huge loss, you would have to amend the return and then amend subsequent returns in order to claim it. So better to be proactive and do it now, calculate, account for everything today. Any questions there? No?
I don't see any questions so far. Let's keep going.
Great.
Oh, wait, we got one question. How do we know how much we can carry over?
Oh, the full amount of anything that resulted from reasonable and necessary expenses can be carried over in total. Self-employment health insurance, this for sole proprietorships and LLCs, you get to deduct the premiums for health insurance as self-employed expenses. For S Corps and C Corps, this is treated a little differently. The C Corp should really have a plan, medical plan, and cover the employees. For S Corps, the company doesn't get a deduction, but the owner can take the deduction in the personal return. So important to understand the distinction once you speak with your tax advisor. Time is flying, isn't it? I can't believe it's almost 12:40. Okay, meal costs. I wanted to bring this up because meals that are necessary to conduct business, meals to when you travel, or meal to meet a candidate or a board member, are deductible up to 50%. When you take a client out, they're deductible up to 50%. You still show the 100 because the tax software will take care of the rest. You should show 100% of the expenses in your financial data, and then when the return is done, only 50% will be deductible. And I wanted to bring this up because entertainment expenses are no longer deductible. Zero. And this includes you taking your client out to a ball game, to a bowling game, or buying tickets for a concert. Not deductible. A company event, like a holiday party, is deductible. So there is a distinction there. So having a holiday party for your team, that's all deductible, but taking your customers out to the Yankees game is not. And I think this is the last one on the deductions. Bonus and Section 179 depreciation expense. So what this relates to is accelerated depreciation or expense for equipment. This includes computers, film equipment, office equipment. So what the IRS is allowing us to do is to take a very large deduction for equipment that you put in place for your business. Traditionally, and general accounting, the way it works is that if you have an asset, equipment that has a long life, you are required to spread the cost of that asset for the useful life. So if a computer is supposed to last 3 years, you would spread the cost over 3 years and take the deductions over 3 years. But with the bonus and Section 179 depreciation expense, you can accelerate the full cost of that equipment to the year in which you bought it, which is great. So you can have a computer, you can have a printer that costs $10,000 and take that deduction right away. This does not apply to cars. So cars have a different structure and different requirements, but this would apply to most equipment for business use.
We had one question on the meals when you're attending like a business related conference, let's say for like learning and development, and you're having meals there. So it's not with a client, but you're feeding yourself while you're at this work related conference. What's the story on that?
So the general rule is if you're traveling away from your home, those meals are 50% deductible. There are other gray areas around whether you're not able to make your meal for that day. So if you have a conference in Manhattan and you live in Queens, there are some will say, some CPAs will say, I'll take it because I typically take my lunch to the office, and because I was going to a conference, I couldn't. But generally, it would be the general rule is that you must be away enough from home that you cannot get to the meals that you typically get to, or your office. If you typically buy your lunch when you are at the office, and you can do the same at this conference, it's expected that you're gonna not deduct that, except when you are away from the city that you live in. Do you need clarification? I think I said. Is that good?
There's one extra question about what is the minimum distance for quote away from home?
That is a good question, but there isn't like a minimum distance. Typically what we do is we say if you are outside of the state, it's always a travel. Within the city, or let's say you're going from New York to Westchester, that hasn't come up, but it's a good question, and I can look it up and give an update if you contact me. Okay. Good? All right. So credits. There are a lot of credits out there that are available to businesses, and some of them don't apply to a lot of the businesses that we have today, but it's worth looking them up. I don't have all of them here. I just have 3 that I come across the most, but they are like energy credits. There is work zones credit. There are job credits that if you hire from a certain group, you can take a credit against your taxes. But we don't come across those as much as small businesses. The next 3 that I'm going to talk about are most popular. The first one is the R&D credit. And this credit is available to many industries, not just technology. It's available to technology, food and beverages, manufacturing, engineering. And what this credit relates to is the IRS is giving an incentive to businesses for developing and creating new processes or new products or enhancing new products in the United States. So you must incur the cost in the United States. You must, it can be consultants that you use or your employees, but they must be provided, the services and the work must be done in the United States. And you get up to 10% of the, and R&D refers to research and development, you get up to 10% of your research and development costs back in the form of credit. And you can deduct this dollar for dollar against tax liabilities if you're profitable. But if you're not profitable, you can use the credit to offset payroll taxes if you have employees. There is a study that you need to hire someone to help you with come up with the credit amount. There is some analysis that needs to be done to determine whether the processes that you're developing are actually R&D. And you have to do the cost-benefit analysis of doing that study and what is the benefit that I can potentially get before you just decide to go after this credit. But a lot of tech companies and manufacturing companies I know are taking advantage of this, and it's working well for them. The next one is a credit to incentivize small businesses to set up retirement plans for their employees. You get up to $500 of a credit, and the credit is a dollar for dollar reduction of your tax liability. So if you end up with a tax liability of $10,000 and you get a $500 credit, that means you only pay $9,500. It's different from a deduction. A deduction is reducing your taxable income, which saves you just a tax portion of that amount. And so this is for 3 years, you get a $500 credit. And the other one is if you provide childcare for your staff, you get a credit for related to the cost incurred when you provide this childcare benefits to your employees, and the max is $150,000 per year in credit.
Can we come back to one on the R&D credits?
Yes.
George is asking, what about apparel that involves patents? Would that count?
So the patent itself is not what constitutes what is going to lead to the credit, but the process to create the apparel. If she's coming up with a different process or a different product that doesn't exist, or enhancing one that exists, then yes, she might qualify for the credit. The company will qualify for the credit. That's it? Okay. So I wanted to give you just a few tips on, just tips that I like to share every time I do these workshops. I'll go through this quickly. They're self-explanatory, but I will, if anyone has questions at the end, you can ask me. The first one is always reconcile your bank accounts and credit cards. There is always something wrong if your cash doesn't reconcile to your bank statements. And if you are not using an accounting system, this might be a little difficult, but that's why we recommend that we use an accounting tool, because you can then see that all your accounts reconciled. Don't overstate deductions and don't underestimate income. Report everything, so it doesn't create that way you avoid any flags for potential audits, and you take advantage of your deductions and your carryovers. Pay on time and file on time to avoid compliance issues. Get organized. So if you are using Excel, get neat. If you want to set up QuickBooks or Xero or Wave, this will save you so much time and headache. So I always recommend to do that as early as you can. Don't mix business with personal expenses. This creates a lot of headaches at the end of the year for tax purposes, but also it's hard to know where you are with the business if you have personal expenses in the financials. Let's implement a good process to handle contractors. This is an area of a lot of work at the end of the year to determine who needs a 1099, who doesn't. So what we recommend is that you use one single payment processing method. So if you pay your clients through Zelle or your vendors through Zelle or through QuickBooks, try to use the same one. So at the end of the year, you can run a report and collect W-9s from all your vendors. Don't assume that someone doesn't need a 1099. The W-9 is what's going to determine whether they do or not. Use the right tools for mileage, for accounting, and seek professional help whenever you feel that you don't have all the answers. And then, I don't know, we have, since we did the questions, I can give them an overview of QuickBooks, right? Julia?
We had one question actually that I want to come back to, which
Yes.
is from Samantha. She said she is a multi-member LLC, and what if she goes out to lunch with her team members and she pays for the lunch with her personal bank account in a meeting where they discuss business? Is that considered a deduction?
So they're going outside of the office to have a meeting?
Samantha, can you clarify if it's outside of the office or if you're ordering lunch into the office for a meeting? No, in another state, she says.
Okay. So yes, that would qualify as a deduction if they're conducting a meeting and they are, and she's buying the meals with her card. She can deduct it, and she can do it in one of two ways. She can, as a single, she's not a single member, as a partnership. If they're filing as a partnership, her income is going to show up in her personal return as self-employment income, and as such, she can deduct expenses directly in her personal return. Or she can have the company reimburse her for the expense.
Okay, and then we have another question from Karen, which is, if you're paying a business, a web developer company or a design company, do you issue a 1099 or just list it as an expense?
So it is an expense. The 1099 is separate. It's in addition to. So it is that's a business expense. The 1099 is a reporting requirement to the IRS and to the person you pay. So the general rule is that anyone making $600 or more from you in a year and providing a service, and B is an LLC or sole proprietorship, not a registered business, should get a 1099 or must get a 1099 from the business. So products are excluded, and C corps are excluded, and S corps. Those are the general rules, but the IRS has a link on this, a page on this that explains everything. I'm happy to share that also.
So even if a vendor is an LLC, for example, they would get a 1099?
Yes. Yes. Any other questions?
Any other questions? We'll give it a few more seconds. Okay, let's move on.
Great. So I will give you quickly a demo of QuickBooks. Unless everyone on the online already uses it.
Let's just show it anyway, because we're recording anyway.
Great. So and my contact information is going to be at the end of the slides for anyone that goes back to them later on. So if we go to QuickBooks, when you first create a QuickBooks account, it's going to be slightly different, but you're going to have a pop-up that says, let's connect your bank account. And I'll show you what that looks like. One thing I wanted to know for anyone who doesn't have QuickBooks, if you get it through an accountant that gets the wholesale pricing, and that person passes on the discount to you, you can get QuickBooks at 50% off from the regular price, which is what we do. We pass this on to clients. So if you're thinking of getting QuickBooks, talk to your accountant and see if they are willing to add you to their wholesale plan and give you the discount. So the first place you end up at when you are setting up QuickBooks might look like this. The screen that says, now I'm going to click on add account, but when you first set up QuickBooks, it will prompt you to link your bank account to it. And what this is going to do is bring in all your transactions on a daily basis and allow you to then classify them. and keep them organized into an income statement or a balance sheet. Once the bank account is connected, this is where they show up. So it's like the different bank accounts, and then the transactions that come in will be at the bottom here. And then you classify them into categories. And the categories will be generic at the beginning, but you can create your own, and you can either learn that by going through help, or watching YouTube videos, or going to one of my workshops. I have one this Friday for those who are watching live. And once you classify the transactions, so let's pretend this is this one, for example. I click on it and I say, oh, this lamination was office expense. I click, I select it. You can add a memo, and then on the right here, I select add. And that transaction is already in my income statement. Once you classify everything in this tab for a given month, you can then go to your reports on the left and ask QuickBooks to give you your profit and loss. This is once everything is done. So while that loads, let me add that you can use QuickBooks to invoice your customers, and you send the invoices directly from the system, and they have the option of paying you directly from the invoice by adding their ACH information or credit card information. But I'm on reports now, and if you go to profit and loss, this is the report that will tell you at any point in time, once you have classified all your transactions for all the bank accounts, how your business is doing. And this is the report that your accountant will use to prepare your tax returns. So you can change dates here. If you're on a cash basis, you select cash. If you're accrual, you select accrual. And then down here, you can see your income and expenses and your net profit at the bottom. To get to this, of course, a lot of things happened before, which we don't have time to cover today, but basically, your income comes from either you billing your customers through QuickBooks, or you posting cash receipts from customers into these accounts. These accounts are customizable. You can create your own coaching services, app sales. These are all editable, so you can change them as you like. And then down here where you have expenses, you can set it, you can create subcategories. You can have compensation groups, you can have marketing groupings, and then that way you can do ratio analysis to see how much you're spending in one category versus the other. You can also run your reports by periods. So here I'm going to say, give me my report by month. And when you do that, you can do trend analysis and see, like, why did I not make any money in February? Or why did my cost go up? And then you start digging, and that's how you use the information to run, to manage your business better, not only for tax purposes, but to really see how you're doing on a regular basis, and use that information to make adjustments and hopefully improve profitability. Any questions on QuickBooks? There is a lot. I have a class, but I have classes all the time. You can check on my LinkedIn profile and go to one of the QuickBooks training. But any questions now?
Yes, so there's a question about, are you aware of any QuickBooks-like programs for businesses that have a Shopify integration and that can actually have your inventory reflected in the accounting tool?
Yeah, so QuickBooks allows you to do that, to integrate Shopify with QuickBooks. But Shopify, I believe, I have a few clients with Shopify, does not track the inventory. It tracks the inventory sold, but the inventory on hand, as far as at least the versions that I've seen, doesn't track the inventory on hand. And if it does, then you'll be able to manage it there. But what I have seen clients do is use an inventory application and plus Shopify.
Great. And to Georgia's question, yes, we can share. Are you fine with us sharing these slides, Ramona, afterwards, sharing the slide deck? And then, yes, the webinar will be recorded, everyone. It'll be up in our workshops library within 24 hours. Any more questions? We have about 2 minutes left. Don't be shy, everyone. We'll give you a couple of seconds to type. There's no question too small.
Mhm.
Okay, Ramona, any last remarks before we sign off? Oh, we have one question. What's the first step to getting organized financially?
So the first step is to understand what your business transactions are made up of, right? So if you have been operating your business from a personal card and your business card and 5 cards and business account that we don't know, the first thing is to do an inventory of where are my business transactions coming from, and then how do I implement a process to keep it all together. So even before you tell me I want QuickBooks, I'm going to ask you, how are you managing your transactions today? And then we have to change the habits that are not in line with having best practices for accounting. And if we're willing to make those changes, then where do we track this in the best, in a productive way, efficient way? Is it QuickBooks? You might be able to use Wave, which is free, or there might be another application that you need. But yes, I'd like to understand first, I would like you to understand where is it that everything is flowing from, and then starting from there to decide what next step to take.
Great. That is all we have time for, unfortunately. I saw a few questions pop up, but we will circulate this deck, which has Ramona's email address on it, so you can just shoot those questions directly to her. Thank you so much, Ramona. This was so helpful. We will be sharing out just some top-level insights in our Slack community, and we look forward to staying in touch. Thank you so much.
Thank you. Thank you. This is great. And thank you for all the great questions. You guys were awesome.
So helpful. Claps from the chat room coming in.
Great. Thanks.
Thanks, Ramona. Bye-bye.
Bye.